In early January 2026, silver prices fluctuate around $75 to $80 per ounce after a volatile end to 2025, where the metal surged over 150% from the previous year to briefly exceed $81. This dramatic rise, far outpacing gold, stems from a perfect storm of structural supply deficits and exploding industrial demand that shows no signs of abating. As the world accelerates toward electrification and digitalization, silver emerges as an indispensable component in solar panels, electric vehicles, and data centers powering artificial intelligence. The stakes are immense in 2026. On January 1st, China's Ministry of Commerce implemented a new export licensing regime for silver, approving only 44 company ES to ship the metal abroad for the next 2 years. This policy, elevating silver to strategic status alongside tungsten and antimony, tightens control over roughly 60-70% of global refined silver exports, exacerbating an already severe market imbalance. For 5 consecutive years through 2025, the silver market has recorded substantial deficits, with the Silver Institute estimating a 95 million ounce shortfall in the final year alone. Cumulative deficits since 2021 approach 820 million ounces, draining above ground stocks as industrial users compete fiercely for physical metal. In 2026, analysts warn that China's restrictions could deepen this crunch, potentially propelling prices toward $100 per ounce or higher. At the center of this tension lies silver's dual role as both a precious monetary asset and the highest conducting industrial metal. Demand from photovoltaics alone is projected to set new records, while electric vehicles and AI infrastructure add relentless pressure. Investors and manufacturers alike face a pivotal question. How high must prices climb to ration scarce supply? The urgency intensifies as global inventories dwindle. China's move, requiring exporters to meet rigorous criteria like minimum production thresholds, effectively sidelines smaller players and prioritizes domestic needs. Elon Musk himself highlighted the risks, noting silver's critical role in I&D industrial processes amid soaring prices. This is not a transient spike, but a structural shift. With mine production stagnant and recycling insufficient to bridge the gap, 2026 stands as a potential inflection point where supply constraints collide with unstoppable technological demand. Silver's journey as a cornerstone of human civilization spans millennia, from ancient coins in Lydia around 600 BC to its role in global trade routes that shaped empires. In the modern era, the metal's price has experienced dramatic surges tied to supply disruptions and industrial booms, most notably in 1980 when the Hunt brothers attempted to corner the market, driving prices from $11 to nearly $50 per ounce in months. That episode ended in a crash, but it highlighted silver's volatility when physical supply tightens against speculative demand. China's ascent in silver production began accelerating in the early 2000s, transforming it into the world's dominant refiner by the 2010s. By 2025, Chinese mines and refineries accounted for approximately 60 to 70% of global refined output, a position built on vast domestic resources and state-supported industrial expansion. This dominance echoed earlier precedents, such as China's rare earth export quotas in 2010, which slashed shipments and tripled prices for those critical elements amid trade tensions. The roots of today's market imbalance trace to the post 2008 era, when silver demand recovered faster than mining output amid green technology growth. Photovoltaic installations began consuming ever larger quantities, rising from negligible amounts in the 1990s to hundreds of millions of ounces annually by the 2020s. Electric vehicles and electronics further compounded this, establishing silver's indispensable status in conductivity-dependent applications. Past price spikes often coincided with export controls on strategic metals. In 2010-2011, China's rare earth restrictions sparked global scrambling for alternatives, while antimony curbs in recent years drove similar volatility. Silver, long treated as a commodity rather than a critical miner at all, escaped such measures until late 2025, when Beijing signaled its elevation to strategic status. By December 2025, as silver traded near record highs above $80 per ounce, the Ministry of Commerce announced the new licensing regime effective January 1st, 2026. This policy, approving only 404 companies for exports through 2027, built on years of growing domestic prioritization amid structural deficits that had persisted since 2021. The Silver Institute documented these shortfalls, culminating in a 95 million ounce deficit for 2025 alone. China's move in 2026 thus represents not an abrupt shift, but the culmination of a decades-long consolidation of supply power, now intersecting with unprecedented industrial hunger. As global inventories dwindled from cumulative deficits approaching 820 million ounces, the stage was set for the restrictions to ignite the next phase of silver's turbulent history. The core mechanism driving silver's volatility in early 2026 lies in China's new export licensing regime, implemented on January 1st and administered by the Ministry of Commerce. This system requires exporters to secure special government licenses, with only 44 companies approved for the 2026-2027 period, 2 more than in 2025, but still imposing stringent qualifications such as proven export history from 2022-2024 and minimum production thresholds. By elevating silver to strategic status alongside tungsten and antimony, Beijing effectively prioritizes domestic industrial needs over global supply, controlling 60 to 70% of refined output. This licensing framework replaces previous quotas, creating administrative barriers that sideline smaller exporters and introduce delays in international shipments. As China's refineries process the bulk of global silver, even modest restrictions amplify existing deficits, where demand has exceeded supply for 5 consecutive years through 2025. The Silver Institute reported a 95 million ounce shortfall in 2025 alone, drawing down above ground stocks amid relentless consumption from photovoltaics and electronics. Industrial demand forms the unrelenting engine behind this imbalance. Solar photovoltaic installations continue their exponential growth, with silver's conductivity essential in panel efficiency despite thrifting efforts. Electric vehicles incorporate significantly more silver than traditional engines, while data centers supporting artificial intelligence require vast quantities for high-performance components and power infrastructure. Consequences materialize swiftly in early 2026, with prices fluctuating between $74 and $78 per ounce after peaking above $80 late in 2025. Analysts attribute ongoing tightness to the restrictions, warning of deepened shortages as exporters navigate approvals. Global manufacturers in solar and automotive sectors face higher costs and potential delays, prompting some to accelerate stockpiling. The restrictions also intersect with broader geopolitical dynamics, echoing China's past controls on rare earths that reshaped supply chains. For silver, the impact manifests in elevated lease rates and futures volatility as physical delivery pressures mount. Investment flows provide additional support, with exchange-traded products recording strong inflows amid perceptions of silver as both monetary hedge and critical commodity. As deficits persist into 2026, the mechanism reveals a structural vulnerability. Mine production remains stagnant near 835 million ounces annually, insufficient AGA industrial appetite projected to exceed previous records. Recycling contributes but falls short, leaving prices as the primary rationing tool in a market where substitution proves challenging. The deeper revelation in 2026 is that silver has transcended its traditional role as a precious metal to become a cornerstone of strategic geopolitical leverage. China's export licensing regime, by restricting shipments through just 44 approved entities, exposes the fragility of global supply chains dependent on a single dominant producer. This calculated consolidation mirrors Beijing's mastery over rare earths a decade earlier, reminding the world that control over critical materials translates directly into economic and technological influence. As deficits compound and inventories approach critically low levels, the market confronts an uncomfortable truth. Industrial demand, led by solar and electrification, is structurally embedded and growing exponentially. Substitution efforts yield marginal gains, while new mining projects face years of delays and escalating costs. Prices, already testing $80 per ounce in early 2026, serve as the only effective mechanism to balance this equation, with analysts forecasting sustained upward pressure toward $100 and potentially beyond. Power structures crystallize around this scarcity. Nations pursuing energy transitions and digital sovereignty find themselves vulnerable to supply disruptions, prompting accelerated efforts to diversify sources and build strategic reserves. Investors, observing the pattern of past controlled commodities, increasingly allocate toward physical silver and related equities as a hedge against both inflation and technological bottlenecks. The implications extend far into the decade, with photovoltaic and electric vehicle adoption accelerating under policy mandates worldwide. Silver consumption is poised to set consecutive records absent a major economic downturn. China's restrictions, while not an outright embargo, introduce persistent uncertainty that amplifies volatility and rewards those positioned in physical metal. In conclusion, the surge past $80 in 2026 marks not a speculative bubble, but the emergence of silver's new era as a constrained strategic resource. The combination of chronic deficits and export controls has ignited a breakout that reflects deeper shifts in global manufacturing and energy. For markets and policymakers alike, the message is clear. In the race toward an electrified future, silver's scarcity will continue to dictate terms.